Hello and welcome to the FrontierView's webinar on Russia CIS Outlook for 2021. I'm Zeynep Köseday-Solu, Director for Middle East Africa and Turkey Research. Before we get started, we realize that some of you may be new to FrontierView, so we'd like to take a minute to provide you with a very quick overview of our firm and how we work with executives at major multinationals. In this slide that you see here, FrontierView provides the world's best market intelligence and advisory services for global business professionals. We help our clients grow and win in their most important markets by informing and powering their market monitoring, planning, execution, and other critical decision-making processes. With continuous research and insights, custom solutions, and transaction support services, we provide our clients, a small sample of which you can see here, with timely, actionable insights to adapt and win in changing markets. If you are not a client and are interested in receiving a 60-day complimentary access to our FrontierView program, please leave a comment in the chat box or email us at info@frontierview.com. Today's FrontierView's Director for Europe and Russia CIS, Mark McNamee, will be leading the presentation. If there are any insights you see today as part of this discussion or any questions we don't get to answer, our client services team will be happy to follow up with you directly. And I think with that, I'll turn it over to Mark now to take us through the agenda.
Great, thank you very much, Zeynep. And just a brief introduction for Zeynep, who is moderating this discussion with me. She's the Director for Middle East and Africa as well. So for today, we will be covering Russia's sort of revival, recovery out of the COVID pandemic and expectations for the rest of the year and into 2022. The most common question we have been hearing for the last several months from all of our clients across the client base, so B2C, B2B, healthcare, etc., has been, can this solid revival that we've seen the last several months, really since about the beginning of the year or late Q1, continue consistently through the rest of the year and into 2022. So that's sort of what we will try to tackle going through this. So we'll start with some key takeaways of what you can expect, some of the key themes from today's presentation. Then we'll start, of course, at the macro level, looking at the global outlook of things, US, developments, China, vaccine campaigns, etc. Then we'll dig more regionally into Russian CIS, and in particular, COVID management and the vaccine campaigns. And then we will dive into our specific outlook for Russia, excuse me, for the rest of the year, as well as some core CIS markets. And then, of course, please, as Zeynep mentioned, submit your Q&A, any questions you have. So we'll have Q&A at the end of the session. So to begin, the good news is that we've seen a domestic revival, but a lot of this has been aided by this strong external environment, quite resilient recoveries since the end of last year and throughout this year out of Asia, which has really helped drive up demand for commodities across the board, as well as this very sharp revival out of the United States since the beginning of the year, thanks to the extremely fast vaccination campaign here in the United States. That has helped drive commodity prices higher and therefore energy and other export revenues, agriculture included, across the entire CIS region. That doesn't mean there aren't concerns, of course. So is there a third wave is another common question we've been hearing from clients, particularly in Russia. We will talk about this. We feel fairly optimistic. The point being that even if there happens to be a third wave at any point between now and the rest of the year, the likelihood of harsh restrictions being reimposed, particularly in Russia, remains quite unlikely. So the outlook is still relatively optimistic, almost regardless of COVID management for the rest of the year in Russia in particular. So Ukraine, however, would be a little bit more at risk, Kazakhstan to an extent as well, but the largest market, of course, being Russia, a little bit safer there most likely. So we'll talk about that. Generally speaking, when you're looking across consumer activity, business activity, investment, and you're looking across all of these core markets within the region, we are seeing very clearly a nice broad-based recovery. When you consider where these economies were 9 months ago, 6 months ago, right at the beginning of the year, and where they've developed as we are moving into Q3 here, at the beginning of June, we are seeing nice revivals, manufacturing, even within mining to an extent, and then consumer activity as well. Our expectation is that this should continue for several months, though some questions and some structural issues should arise again towards the end of this year and moving into 2022. Again, this is the most common question we're hearing across the board from clients. I'll describe the trend we're expecting, but we do anticipate, generally speaking, at least a mild slowdown as some of the structural limitations on growth across the region reappear as we move into 2022. So it's generally a positive message. That said, there are some concerns. Naturally, the slow vaccine campaigns do hold back some sentiment, if nothing else, not to mention, of course, the potential for example, in Ukraine or Kazakhstan, reimposed restrictions, and then, of course, geopolitical risks. U.S.-Russian relations are at one of their lowest points, really, in the last 40 years. That continues to sort of keep the risk premium up on these markets, on these currencies, right? So the spillover impact from some of this depreciation pressure from the ruble onto a number of CIS currencies. And that will remain for the long term, though we're at a moment where we're starting to become mildly optimistic that we could see improvements in these currencies based upon the upcoming Biden-Putin summit here on the 16th of June. So we'll discuss that here. And then another point to pay attention to, which we feel that maybe clients aren't necessarily taking into account, particularly B2C clients, is the potential slowdown in credit growth, consumer credit in particular, in the second half of the year. Some concerns because of the fast rise in credit over the last year of a burgeoning, very mild, but burgeoning bubble on the credit side, on the consumer credit side of things in particular, and therefore some likely imposed limitations by the financial sector within Russia in particular on credit lending going forward the rest of this year, which of course will naturally impact demand. That said, that will be also going on by another pressure in the terms of relatively high prices compared to the last several years here. So dealing with managing some of these things could become a bit of an issue for some clients moving towards the end of the year. So as mentioned, we'll start with the global outlook. So kind of looking from top down at very high level, we have seen vaccination campaigns very fortunately in these major markets of the United States, of UK, of Western Europe critically, improving dramatically over the last 2 months now. The United States has been accelerating very fast since the beginning of the year. When you consider about half of the United States population has been vaccinated with at least one dose, that amounts to about roughly 170 million people who have currently been vaccinated with a single dose. And then in the United Kingdom, similarly, we're approaching 60% of people having been vaccinated. That again, we're talking about 40 million people or so with at least one dose of the vaccine. Critically, though, we've seen in Western Europe the pace of the vaccine campaign picking up dramatically, really since about the beginning of April, and not a second too late, as those markets were lagging well behind most of these other, well, the United States and UK, a couple of months behind. This acceleration in the vaccine campaign should continue in June, in July, in August, particularly as supply issues, which is what held back the vaccine campaigns in Q1, are resolved, and we're going to see a considerable uptick in supply here this month and in Q3, which will then drive Western European growth and recovery very well, which of course will support commodity prices as well. Unfortunately, when you look at CIS markets, Russia, Kazakhstan also around 11% or so, Ukraine only a couple percentage of the population have received a single dose. This could become problematic in the region in the coming months, but we'll discuss that shortly. Looking now at sort of the global level, obviously the COVID pandemic last year and then the vaccination campaigns this year is what's dictated. These are the fundamental factors dictating these growth trajectories within these regions primarily, of course. So other factors naturally are involved, but for example, we're seeing within a number of these regions, Western Europe, obviously, with such harsh lockdowns, right, having extreme contraction in growth in 2020, and then a decent but still relatively mild recovery in 2021, led by UK and Germany. But moving on, looking at some of the other regions, United States in particular is rebounding very quickly. A lot of government support in 2020, which has had positive implications in 2021 with additional government support by the Biden administration here in this year, which is driving a sharp recovery and why the United States will recover all of that lost growth from 2020. Central and Eastern Europe, the point here is that they remain some of the most appealing markets, some of the most resilient markets, as you can see, that drop of only around 2% in 2020, some of the most resilient markets across the entire world, and then quite a solid bounce back as well. So recovering all of that lost growth by the end of this year too. Zainab, I'll let you make a quick statement about Middle East and Africa, since obviously when executives from CEE are competing for resources within the EMEA region, oftentimes they're competing with, of course, executives within their company out of Middle East and North Africa.
Of course, I think what we're seeing in this region, Turkey, Middle East, Africa as well, definitely emerging from that harsh hit of the pandemic from 2020, we are seeing that MENA and Sub-Saharan Africa are growing in 2021 at right in the middle of that global average, but there's a lot of divergence between the markets. Those with larger local economies like Turkey, Egypt, Saudi, they are recovering relatively faster. Those that are experiencing additional fiscal or political challenges like Iraq, Iran, Lebanon, Algeria, of course, really lagging and falling behind the regional average growth. And when we look at Sub-Saharan Africa, you're seeing the larger markets, South Africa, Nigeria, struggling. South Africa, we're expected to recover to pre-pandemic levels towards 2024. Nigeria, challenged by high inflation, moderate growth, insecurity, but the smaller, more insulated markets in Sub-Saharan Africa are keeping that the average that you see here relatively higher. And I think what we're seeing in terms of investment attention, Turkey, Saudi Arabia, and UAE, Egypt are the top markets that executives are evaluating, but quite a bit of risk across all of them.
Mm-hmm. Great, thank you for that. So what I want to show here related to that, of course, is peering down into some of the primary emerging markets within EMEA. This is another reason why Central and Eastern European markets, you can see here, so including Poland as well as Turkey, are recovering faster than most of the region. And critically, Poland and Russia are some of the larger emerging markets, right, within the emerging EMEA region. So you can see getting back to that 2019 level of growth, sort of erasing all those losses of 2020 by the end of this year, which is, again, even globally speaking, very strong performance compared to, say, Latin America or a number of our markets, even within EMEA as well as in Asia. So very positive performance. And this is why we've seen from surveys we've taken of top executives amongst our clients within EMEA, when they look at the EMEA portfolio, where do they sort of see? So if you look at the x-axis here, which region are they expecting to see the earliest normalization period, right? So Russia CIS obviously being seen quite positively by most of our clients. You can also see where the bubble size indicates where they expect to be putting the largest additional investment. So Russia, naturally, Russia CIS getting a lot of that additional investment alongside Central Europe. And then if you sort of look at the y-axis, where do you first see the biggest risks? Russia CIS, Central Europe, seen as actually far less risky than most of the other regions. So kind of benefiting on both sides, right? Less risk, most opportunities, hence they're getting some of the strongest investment in the region for those very reasons. One of those reasons driving that, as Russia, Kazakhstan, Azerbaijan, a lot of these primary markets within CIS are major energy exporters. The surprisingly high energy prices that we've seen since the beginning of the year have really supported a lot of the public spending and overall fiscal support and monetary support that continued into this year. And we're seeing spending well beyond budget plans. This is extremely positive. We've in fact raised our forecast for oil prices for this year to $66 a barrel. A lot of this is sentiment driven. On the demand side, obviously, this is been driven by the accelerating vaccination campaigns out of the US and more recently out of Western Europe, which has really put sort of the support base for these high prices above $60 a barrel that we've seen since about February now. On the supply side, I'll turn it over to Zainab if you wouldn't mind making a quick comment on OPEC negotiations and Saudi's point of view when it comes to energy output and restrictions that we've seen so far this year and moving into the rest of the year and into 2022. Zainab,
Sure.
would you mind?
Of course. And here, I think what we see, as you mentioned, is a relatively good pickup in demand that OPEC is currently observing. This was delayed after the Q1 kind of very, very low levels of demand. And so basically, Saudi Arabia and OPEC would like to stay on course in terms of gradually increasing their production and returning some of their oil into the market. The reason is currently the oil prices are quite supportive of the budgets, oil exporting countries' budgets in the region. However, of course, these countries, especially Saudi Arabia, does not want to see oil prices around $70 per barrel if it is caused by their own production cuts. That does create a market share challenge where these kinds of higher elevated prices can really encourage more production growth from the shale side. And at that point, it's going to become more difficult for Saudi oil to come back and re-win that market share. So they would likely stay on course, gradually increase production, and provide more supply into the markets. We're also very closely watching the Iran-US negotiations. Our base case is that they would want to start having that framework of a new nuclear deal this year, but we do not expect a massive Iranian kind of oil supply into the market that could provide a serious downward push on prices. That's going to be quite a gradual return of Iranian oil, and we think it's unlikely before next year.
Great, thank you for that. That's helpful. And what you remembered here, the trajectory is still into next year in 2023, a slowdown in these prices. So we should be seeing prices moving towards $60 a barrel and lower, driven by the end of the OPEC deal, and then also these elevated prices, which allows US shale producers in particular to come back online. And that's expected at some point in about a year from now towards the end of next year, which will really, of course, bring down prices then. Another factor, though, related to some of the cost side pressures that we're seeing across B2B businesses in particular, and in Russia, but globally speaking, relates to these shipping issues. So we're seeing obviously these high energy prices. We're also seeing high food prices, and part of the high food prices are related to the shipping issues that we've seen around the world as governments have loosened restrictions, and then ships are being sent to and from different countries, and then we're seeing all these sort of bottlenecks and supply chain issues, which is driving up these costs. This is one of the clear and prominent drivers, unfortunately, of these higher costs that we're seeing, which are then being passed on to businesses and then ultimately to consumers as well. So you get an idea. I won't go through everything here, but you can review these slides, of course, after the presentation. But these record shipping prices that we've been seeing, these bottlenecks globally speaking, there is both a demand side story, which are some of the drivers you're seeing here. A lot of this, of course, lockdown driven, sort of spending on goods, but then also supply side, which I'll show you in a second. But the point here is that a lot of these drivers will last at least through Q3 and into Q4, which means a lot of these cost pressures are going to remain at least for the rest of this year, and many of them will be lingering deep into 2022 as well, which means you're going to be having cost side pressures, particularly the B2B firms, right? Cost side pressures, which of course over the period of months will be passed on gradually to consumers as well. If you look at the second driver, the lack of ships and containers, this has been a problem for the last about year. Very, very critical driver of this issue, and this will take considerable amount of time. Really, it'll take towards about the end of the year to be sort of sorted out, which of course will continue that pressure. Another issue related to some of this cost pressure relates to the geopolitical issues and the resulting ruble depreciation, which then has had spillover impact on depreciation of CIS currencies, and in particular the Kazakh tenge. So just a quick word. Of course, we could spend about 2 hours talking about U.S.-Russian relations, but trying to get to the meat of the issue and what it means for businesses and investment and sentiment in the market. So if you look at the timeline here, you get an idea that we've already seen sanctions, right? In March, following Navalny's arrest and then the crackdown on the protests. Then we saw another round, of course, in response to the cyber hack that was unveiled at the end of last year, as well as revelations about continued election meddling, not just in 2016, but then in the 2020 election. So we saw these sanctions come in, particularly in April, the sanctions on Russian sovereign debt, which were quite strong sanctions, but the important part of those sanctions were the the very explicit threat of future sanctions should U.S. perceive Russia's international behavior as being continually aggressive within its within the CIS sphere, as well as in its relations with Western Europe and the United States. So more sanctions were threatened, particularly in financial markets, but also against particular oligarchs and just dirty money in general. So we could see another acceleration, another round of sanctions coming up at some point. That said, and driven by numerous flashpoints, of course. That said, even after the incident with Belarus, even after the buildup of the troops along the Ukrainian border, it's clear that the Biden administration is trying to present a very firm posture towards Russia, but at the same time does not want to escalate tensions and has made very clear and deliberate moves to try to de-escalate the situation. This was seen with removing the sanctions against Nord Stream 2. That was partially, of course, driven by the preference for improving relations with Germany, naturally, but then also other things like softening the general rhetoric, as well as agreeing to this summit on June 16th, in which essentially we should not expect a lot out of, but we should see the United States in particular putting down some firm red lines with Russia and just trying to stabilize and de-escalate the situation further. Putin, likewise, on their end, while we are seeing tough rhetoric, behind it all likely does not want to see an escalation in tensions either. So the hope is, after this meeting, we can see some clear and distinct sort of guidelines for the future of the relationship. So we're not going to see necessarily a drastic moderation of tensions, but we could see a more stable equilibrium and sort of more clear rules of the game, if you will, while relations, unfortunately for the long term, will remain extremely hostile, you could even say. So what could be the response then on the other side from Russia related to this? So particularly iconic American brands would remain naturally more vulnerable to potential sanctions, regulatory issues, more compliance with checks at the border and things like this, which Russia has done in response to previous iterations of sanctions over the last 6-7 years as well. So something to be paying attention to naturally will be this upcoming summit on the 16th and the response by both governments then afterwards. I wouldn't say that there's going to be a clear improvement, but the hope is just simply a moderation of tensions, hopefully. That said, since the situation is so hostile between the two sides, and frankly, this is the worst point in U.S.-Russian relations really since the pre-Gorbachev era. So really, we're going back nearly 40 years. The issue here is that you have these geopolitical tensions, right? Russia, from its point of view, does not want to worsen the situation, of course, but they still need to show a strong face, of course, against the United States and the West. So the concern here is that with such tensions internationally would be a miscalculation or mistake, which is what we're hoping from the Biden-Putin summit. The two leaders can simply ameliorate or moderate or lessen the risk of that miscalculation or mistake amid such a hostile environment, of course. Looking from the Russian perspective, right? So the geopolitics, they want to keep things rather tense, which can strengthen the domestic support base, particularly in advance of September elections, but then, of course, no actual conflict. When you add in also then the domestic pressure, we've seen, of course, the major protests back in January and the arrest of Navalny. Clear repression, but of course not too much repression to cause a backlash, as was seen, for example, last year in Belarus. This balancing act, whether it comes to geopolitics or whether it comes to the domestic opposition, or even with the domestic media, manipulating the message, but not too much to create obvious distrust amongst the population. Again, a little balancing act. And then most critically, and we're talking long term here, I'm bringing this up because this is one of the most common questions I'm hearing from clients consistently is, what is the future of this relationship? How are we going to manage this the next 3.5 years of this Biden administration with a stronger posture towards Russia? Obviously, Putin up for re-election in 2024 and looking to likely remain in power after 2024. So how does this develop? As mentioned, the biggest risk would be one side making a miscalculation, misreading some statement or general mistake. But from the Russian point of view, the Kremlin's point of view, the biggest risk really is keeping the elites rather at least satisfied, right? So rewarding the elites, of course, as they've been rewarded for the last 20 years, 30 years really, but of course not too much to sort of slow down economic growth, and then also keeping them happy enough so that you don't create opposition factions within the elite, which frankly is really the only threat to the Putin regime, would be from an opposing faction developing amongst elites. So in either case, I want to make quick mention of that because that's another major question I've been hearing consistently from clients for the last couple of months. So another sort of cost factor, as mentioned, was some of this depreciation of the ruble that we saw last year. Fortunately, as you can see, the ruble, as well as the other major CIS currencies, since January 1st, we've seen actually these currencies being relatively stable, if not appreciating, between January 1st and June 1st. Very positive performance, and this is better than expectations. This is why we've also revised up the hryvnia over the course of the year to perform better than originally anticipated. And the ruble, we still have, if you can see our forecast here, we still are a little bit pessimistic due to the risk premium related to the very, of course, tense U.S.-Russian relations. That said, we're watching closely for this upcoming summit and the hope that we get some positive news, and then in which point we would then appreciate our forecast for the ruble, assuming this summit does go relatively well. So for now, we still remain relatively pessimistic on the ruble, which also causes us to remain relatively pessimistic on the tenge as well. But if we do move our currency forecast, we would be moving towards more appreciation, closer towards our 2022 forecast. So we will see, of course, we'll be watching that closely, but the good news is that the bias is now moving towards appreciation. All of that said, when you take into that entire context, what we've been hearing in Russia CIS are these basically executional priorities. So I won't go through everything here, but when you're looking at the next couple of months, what we're hearing consistently is sort of this this hybrid working model, right? So that involves both the work model of returning to the office, right? But then also in terms of dealing with local partners, retailers, distributors in the market, and in person through digital, what's the new sort of stable equilibrium that we'll be moving towards? And that's something that all of our clients will be sort of adapting over the rest of this year, of that approach of using digital tools and responding to customer needs as appropriate. So this is what we've been hearing consistently, and then we're going to move into basically the new working model by the beginning of 2022, and this new post-COVID environment, right? So setting up the business for that. So all of that said, we'll move now into the COVID aspect of the Russia CIS picture here. So as you can see, we've dealt with multiple waves since the beginning of the pandemic. The waves have been flattened, but the risks remain. We still see, for example, relatively sticky high levels within Russia in particular, even by the end of May and early June here, of COVID cases. The expectation is that we will see, thanks a lot to weather conditions, we should see, as we saw last summer, a further slowdown in cases. But the very slow vaccination campaigns, unfortunately, maintain an elevated risk of another potential wave, if not this summer, which we find to be relatively unlikely, thanks mostly to weather, then moving into Q4, as unfortunately most of this population will remain vulnerable as they will not have been vaccinated. So as you can see here from the chart, Azerbaijan has been leading the region, but still only around 13–14% of its people vaccinated as of the beginning of June. Russia and Kazakhstan still only around 11–12% of its populations. When you compare that, of course, to Western European figures or the United States, this is way behind naturally. The concern here, particularly for Russia, as well as for Ukraine, is that we see around 60% of people unwilling to become vaccinated ever. This is quite concerning, unfortunately. And so this does keep up that risk of the potential for another wave of COVID. Now, the point here is that in the case of Russia, you can see that restrictions have remained off basically since the initial waves back about a year ago and earlier, and then just moderate restrictions in Q4 of last year. This has kept the economy open. This has driven business and consumer confidence, of course, reinvestment then, and that's why we've seen this in this solid recovery. The point here with Russia is that even, as mentioned earlier, even if we do see another wave of cases, there is extremely low popular approval for another round of restrictions. And particularly in an election year, it's very unlikely then the government would possibly put on another round of restrictions when the people don't want it. And as you can see from polling here, the fear of the virus is very, very low, relatively speaking, to most other countries. So only about 40% of the population is actually afraid of contracting the virus. Meanwhile, only about 40%, 26% specifically, 26% of people willing to be vaccinated, with over 60% unwilling to be vaccinated. So it is likely we will see another uptick in cases at some point in the rest of the year, but it's still also unlikely that we will see another round of restrictions. So that's very good for the Russian market. For Ukraine, we're also seeing high vaccine hesitancy. The good news out of Ukraine, though, is that the majority of people who voice this hesitancy of taking the vaccine, it's more about which vaccine. So they're more open to taking as the AstraZeneca, the Pfizer, any of the Western vaccines, where they're more opposed to taking any of the Chinese vaccines. So that does build a little bit of confidence for Ukraine. That said, the government is going to be more responsive and likely to impose more restrictions later this year, as unfortunately the vaccine campaign really won't be able to take off until next year, most likely at the current rate of vaccinations at least. So we will, it's very likely within Ukraine, we could see another round of restrictions, say in Q4, as winter weather comes along. So pay attention to that. That said, despite another round of restrictions, we saw a couple of rounds in Q1 and in Q2 here in Ukraine, consumer spending and demand overall remain quite resilient. So the impact of restrictions is considerably less than earlier. So if you look here just quickly at our GDP projections, you get an idea of these nice solid bounce backs. Uzbekistan actually never saw even a contraction in growth in 2020, so very consistent, resilient growth on the consumer and business side of things. Very strong public support as well, so government spending quite high. Kazakhstan saw around 2.5% decline in GDP in 2020, but recovering all of that likely in about the coming quarter, or for sure in the second half of this year. And likewise with Ukraine, recovering probably all of that lost growth by the end of this year. So now looking more specifically, we'll take about 10 minutes or so to look at Russia, and then we'll take 5 minutes or so to look at some CIS markets, and then a few minutes for your questions. So let's start with the ruble here first. So we were discussing that earlier. The very good news is that despite those sanctions from the United States and that elevated risk premium in anticipation of the coming sanctions, the ruble has regained all of its lost, all of that depreciation from the beginning of the year, and is actually at its strongest point, roughly, so far in 2021. Again, watch out for this summit. And also the United States is supposed to enact by law another round of sanctions on Russia this month, which would address the financial sector most likely, but of course that'll be determined by the outcomes of the upcoming summit. The impact on inflation, though, has been quite dramatic. So a lot of this had to do with earlier depreciation of the ruble, which then lingered into this year, unfortunately, but also high global food prices, which is really driving up, of course, prices of very common food items, naturally, and then also just reviving demand. So we're seeing on the supply side and the demand side this revival of price growth, and prices in May actually accelerated to 6%. So the issue here is that it's when you see such high increases in prices on very common products that are bought multiple times a week by most consumers, it severely weighs on sentiment. So when people are buying food and they see food prices going up, they're buying food several times a week, this really does weigh on them, their willingness to be buying other products. So this is why we're seeing perceived inflation, according to central bank surveys, around 14.5%, despite the fact that headline actual inflation reported by Rosstat was at 5.5% in April and at 6% in May. So obviously, this has a lot to do naturally with the types of products that are going up. More specifically, though, in May, we also saw not only high food inflation, so consumer prices at 6% in May. You can see that's consistent rise in prices over the last year, driven in part by accelerating food prices as well. But in May, what we also saw was a pressure on the demand side, as we saw price increases rising, price increases on durable goods in particular as well. So as we see the services sector coming back online, and then we're seeing reviving sentiment, we're seeing a lot more demand across the board for all sorts of products, as opposed to more of a focus on food over the course of 2020. So that's really, of course, weighing on sentiment. So what does that mean really for the rest of this year? The expectation is that we'll be returning back to what we've already seen with consumers in Russia over the last 5-6 years, which is very strong demands for promotions, right? Relatively high price sensitivity, very strong focus on quality, right? So getting back to the trends that you were all familiar with back in 2018 and 2019. As mentioned, that observed inflation keeps on accelerating, unfortunately. So this really does weigh on sentiment naturally, as consumers are feeling high prices in stores. The concern is that it makes it very difficult to raise prices on consumers, because we're also seeing, particularly in May, expected inflation actually coming down a little bit. So consumers are seeing currently in stores rising prices, and that impact is being felt. But they're also looking ahead in the next 6 months or a year, are expecting prices to slow down, which means for our B2C clients out there, it makes it difficult to be raising prices. And our B2B clients, it makes it hard for you to necessarily raise prices, since your businesses will find it increasingly more difficult to be passing on their higher costs onto retailers and consumers. Again, very positive story overall, but it should be taken into account that these higher prices is causing interest rates to go up. And we will see another rise in interest rates likely at the next meeting this month, raising probably by about 50 basis points. So we very likely will be seeing interest rates approaching 6% here in the next couple of months in order to control some of these inflationary pressures. Consumer lending, we've seen reviving very strongly so far this year. However, banks are being pushed by the central bank to be raising risk premiums on consumer loans in order to sort of combat this mildly burgeoning credit bubble that I mentioned earlier. Record high levels of credit so far in H1, in which case the government is starting July 1st, will be implementing, putting on higher risk coefficients, in which case we're going to see slower consumer lending. That's absolutely critical, because retail sales for the last 4 to 5 years have been buttressed very, very considerably by high consumer credit levels, as you can see here in this chart, rising by 25% over the course of 2018 and 2019. So something to pay attention to, because we are quite optimistic on consumer spending. Very strong consumer spending for really reviving and consistently growing each month this year. And you can see that sentiment, driving back. And in May, we saw a nice uptick. We expect this to continue. No dramatic acceleration, but improvements. And that's partially due to consistently slowing unemployment. We expect unemployment to have fallen further even in May. And we're approaching these pre-COVID levels. So that's very good. We're seeing consumers sort of getting back their mentality and those drivers of consumer sentiment, getting back to those pre-pandemic days. So that's very good. Unfortunately, we still did see in Q1 real incomes falling by 3.6%. We anticipate that real incomes will grow by the end of the year. So we'll see, say, 2 to 3% growth. So that's very positive. And we saw very high savings across 2020 being spent. We saw this pent-up demand being unleashed into the market, and that'll continue for the next few months. But then we're also seeing on the other side, unfortunately, some slower lending coming and these continued elevated prices. So it's a bit of a mixed picture. Overall, it's positive, and we're going to see continued growth. But our expectation is that there is enough pressure from prices, enough pressure from weak incomes, enough pressure from slowing lending. That's yes, we'll see a continued revival of demand here across in June and across Q3 and into Q4. But towards the end of the year and pretty clearly by about Q1 of next year, a lot of these structural factors, right? The weak income growth, right? Some of the price pressure, the price sensitivity then displayed by consumers. This should all revive it by early next year, getting back to basically the consumer mentality and the purchasing behavior that we saw in 2018 and 2019. So, which is good because of course that means continued growth of spending, but we're going to see some of that hesitancy again to an extent. So expect another 5 to 6 months of pretty solid revival in spending, and then a slowdown as those structural factors reappear. On the business side of things, a very positive story as well. Again, I would give a relatively similar timeline. The very positive revival in demand that we've seen here and demand and confidence should moderate as we move into the end of the year and definitively into Q1 of next year. So we've seen since December this consistent, nice, solid rise as evidence in business confidence, the highest level in 8 years, in fact. Manufacturing was up in Q1 quite solidly, and that's obviously after a high base of the pre-pandemic period of Q1 2020. So that was very positive and actually exceeded expectations. And then we've also seen, of course, very high commodity prices. So we've seen mild industrial production on the mining side of things. That's and driven naturally by the limitations, the restrictions by OPEC, but the very high global prices for oil, copper, iron, a number of other commodities as well. This is keeping up, of course, the revenue base for some of these large industries within Russia, which of course is helping reinvestment levels and the economy to sort of get back on track. Again, as it pertains to price pressures, we've seen producer prices then accelerating each month also across the year. So of course, just more cost pressure, which needs to feed into the market and which will keep inflation relatively elevated, at least for the next several months, likely only moderating maybe by the end of the year. It's November or December, we'll say. All of that said, you can look at the PMI figures. Anything above 50 is considered very positive and an expansion of production. And we're seeing this both on the services side and the manufacturing side. So as mentioned, this nice broad-based recovery across the overall economy. And it's clear here by the numbers. These are figures from through April of this year. You can see oil and gas low, but not as low as last year. So we've seen with the OPEC restrictions being loosened, we've seen clear improvements in oil and gas so far this year as well, which will only improve over the rest of this year. Very beneficial, particularly at very high energy prices. So Russia is very much benefiting as they've cut far less than Saudi, and now they're seeing prices near $70 a barrel, which is far above the $43 a barrel of the budget. But you can see across all of these sectors, auto industry recovering very solidly compared to a very weak 2020, of course. But then you see this broad-based recovery: food, drink, chemicals, construction sector doing well, agriculture stagnating, but that's after a very strong 2020 as well, and that's after a very strong 2019 prior to that too. So all of this we're seeing really helping drive then reinvestment into the economy and getting the economy back on track after that lost year of 2020, which in turn will increase wages over the course of this year and then bring consumer activity even giving more support to consumer activity as well. So very positive story there. And then likewise in the government spending, thanks to the very high energy revenues. This is really allowing the budget to likely perform far better than expected. So we're already seeing spending higher than expected. We're also seeing revenues higher than expected. The plan is for a deficit of 2.4%. That's very, very conservative. Most likely we'll see a deficit of 1% of GDP or even stagnation if energy prices stay well above $65 a barrel the rest of this year. So that's really buttressing then this strong government spending. January through April, we saw an 8% growth in nominal spending. With inflation, and so in real terms, we're seeing about 3 to 4% growth through April. And that's with a budget that was implying about a 5% real cut. So spending is really exceeding plans through April. Social spending, education, industry support, urban development, all well beyond the budget plans. And so this is all very positive. Plus, we're going to see this influx of the announced 400 billion ruble spending plan that Putin unveiled in April in his address to the Federal Council, as well as increased infrastructure spending that will be coming into the market. All of this, of course, partially motivated politically with the September elections coming up here shortly. So all of this very positive also on the public side, supporting that revived business activity as well as that revived consumer activity, which is why Russia has become one of the most appealing markets this year within the EMEA portfolio. You can see our expectations. It's sort of described this clear revival, Q1, Q2. We expect solid growth in Q3 as well. And then we move into Q4, still continued growth. This is on a quarter by quarter basis, right? So for example, in Q4, we're seeing 0.7% growth compared to Q3 of 2021. So continued growth, but a bit of a slowdown, right? Those structural limitations will be reappearing by the end of this year and then holding back some of that revival then naturally in 2022. So I wanted to leave with a quote. This is actually discussed with a client who works for a healthcare company who basically her advice that she said was that COVID is here to stay. COVID will be with us. Unfortunately, we could see further waves of it. And so as Nikolai Karamzin said, nothing new under the moon. What is, it was, it will be forever. So that's a nice mentality to take with COVID. We will be seeing another uptick across this region, likely towards the end of this year. That does not imply further restrictions, and then it'll just become a seasonal issue within the region. So let's just hope the vaccine campaigns can pick up so we can at least sort of deal with the health side, if not the economic side of the pandemic. So I will leave here at the CIS outlook. Please, as a reminder, if you have any questions, please type it into the chat box there so we can address any of those questions. But if not, then I will just move into CIS. I can do this quite quickly because the story is quite similar for the majority of the markets, is that these markets remain some of the most resilient across all of EMEA and frankly across the entire world. Consumer spending reviving strongly each month, showing improvements upon the previous month. And I can say that for nearly every single market within the region. That said, as mentioned earlier, the vaccination campaigns are very slow, which when looking across the region, Ukraine is probably most at risk of another round of potential restrictions later in the year. Kazakhstan potentially as well. Kazakhstan fortunately has less people to vaccinate, so there's more hope for avoiding another round of restrictions later in the year. But that would be the COVID management and the vaccine campaigns would be the primary topic to be monitoring within the whole region. Government support has been very solid as well. So we've seen very high government spending in Q1 across the entire region, thanks primarily, of course, to the high energy prices that we've seen. We're going to also see not only spending exceeding plans considerably, but also much lower deficits than planned, thanks to these very high energy prices. Inflation will remain the primary risk, though, across the entire region. As discussed with Russia, very similar trends with high food prices across the region. And then we're also seeing on the demand side with reviving consumer spending, we're seeing not only the supply push inflation, but the demand pull inflation as well. That, of course, leads to some executional issues, cost pressures to manage with B2B firms, et cetera, et cetera. Of course, in terms of execution, I know many of the clients here online manage these markets through distributors, of course. This really puts to test how to manage distribution in emerging markets in a post-COVID world via these digital pathways. Obviously, we saw much more digital engagement over the course of 2020 and so far in 2021. What does this mean for 6 months from now, 1 year from now? What type of relationships? How often will you be communicating through digital channels? Which digital channels? How soon will we be getting back to traveling to the regions to meet face to face? How valuable is that? How critical is it to your business? So keeping up those relationships and developing that new hybrid model will be a key executional point for the next year. The acceleration of modern trade and retail only took off further over the last year for obvious reasons, due to further consolidation in the market and a lot of the cost and price pressures for retailers. And then what I would advise to clients as has been very clear so far this year is the clear opportunity for these CIS markets to aid the overall Russia CIS portfolio. And this is quite clear here, as you can see. When you're looking at GDP growth in 2021, looking at the non-Russian markets, and by the way, the bubble size here denotes the size of total GDP of all CIS minus Russia in US dollar terms. The bubble, of course, is considerably smaller, but with growth rates over 4%, with Russia's growth rate around 3% or so, the additional GDP in 2021 compared to 2020 is actually quite significant, over $50 billion compared to Russia around $70 billion. So there's a lot of opportunity within the entire CIS portfolio in the aggregate put together to maybe buttress and support the overall Russia CIS portfolio, particularly when it's so competitive in Russia, of course, to be operating, difficulty in raising prices, trying to increase sales volume and market share in such a competitive environment. So you can find maybe opportunities, say in Ukraine or Kazakhstan, both growing by around 4% or so. The additional GDP in each country around $14–15 billion this year. What opportunities can you maybe find in those markets, which can add a few percentage points in total to your revenue base, maybe for the entire Russia CIS portfolio? So something to bear in mind. And I'm mentioning this because I've heard this consistently, particularly from B2C firms, that over the last 2 years, that they've really found that extra effort, right, that extra focus on CIS markets to be very helpful and to prove beneficial to bringing back the hitting the revenue targets demanded by corporate. A lot of this positive story that we've seen relates to the real wage growth. So as you can see here quite clearly, real wages were quite resilient across most of these markets. Again, compared to a lot of emerging markets in the region or around the world, these are very, very strong numbers. We've also seen that continuing in Q1 and beyond for Ukraine in particular, this solid real wage growth. A lot of this has to do with continued government support. So we're seeing the social spending hikes, support for pensions and public sector salaries, minimum wages. All that is putting together a very solid picture, particularly in Kazakhstan and Ukraine. And thankfully, they're also the biggest markets, so you can reap the most benefits in the area. Azerbaijan data looks weak, but that's also coming from a very, very, very high base of H1 2020. So actually, in the aggregate, wages are relatively decent there as well. The issue, again, as mentioned consistently throughout this entire presentation, whether it's Russia or any of these markets, it is the high price pressure, and particularly coming from food inflation. So we are going to continue to see high global food prices for most of the rest of the year, likely moderating maybe come November, December, but only minimally, so still staying relatively high. And then you also have other producer price pressure and energy prices further driving up prices. Uzbekistan is actually off the chart, so we didn't even include Uzbekistan in this chart because their prices are considerably higher on the food side in particular. So all of this will remain, and unfortunately will contribute to considerable price sensitivity across the region, despite the increased sales volumes that will be seen clearly. On the public spending side, as mentioned, very strong public spending, even by Ukraine, not an energy exporter, but the taxation levels have been relatively solid. So the taxation revenues, right? So that has helped sustain some of that government spending, plus the ability to tap international bond markets. So that's been allowed Ukraine, despite its general fiscal pressures, to continue very high spending growth, as well as Kazakhstan, Azerbaijan, thanks to those high energy prices. So this is really helping sustain business and economic confidence overall in the region. Kazakhstan, as mentioned, very solid broad-based recovery is very apparent and will continue the rest of this year. Kazakhstan in the coming months will have basically put the entire pandemic and that contraction of growth of 2020 in the rearview mirror, and everything is really looking very positive. The vaccine campaign being the biggest risk, and needs to start taking off, and then managing inflation pressures will be another critical point. Likewise, Ukraine, some of the strongest consumer spending across all of EMEA, and that was despite COVID restrictions being reimposed in Q1 as well as in April. We still saw accelerating growth each month, and likely saw it in May as well, though the data is not out yet. As mentioned, the vaccine hesitancy is a concern, but as mentioned also, the eventual import next year of Pfizer, Moderna, of the AstraZeneca vaccines, these Western vaccines, will very likely reduce that vaccine hesitance. But the political pressures domestically as well as externally, unfortunately, is restraining investment. Very, very weak investment in Ukraine in 2020, expected very weak investment again in 2021, unfortunately, due to these consistent political issues, whether that be domestic, with now Zelensky showing real genuine efforts to combat the oligarch influence in the country, which of course is only going to lead to further contentions and even potentially new elections maybe in the next year, matched with, of course, pressure from Russia, with, of course, Russian soldiers on the border of Ukraine. So with all that said, again, thank you very much for your time. Happy to take any questions. Zeynep, do we have any questions?
Yes, I think we definitely have questions, and Belarus seems to be on people's minds. I know that it's been on the news a lot, and I think we're hearing basically a few questions, and I'll compile them together. What is the situation? What is the outlook in Belarus? How does that impact Russia? And if you can focus on the currency impact on Belarus and Russia as well related to this.
Sure. Sorry, let me see. Okay, so as far as Belarus is concerned, frankly, Belarus's economy was far more resilient last year. A lot of that had to do with the fact that they did not put on significant restrictions, and unfortunately, the health of the population suffered instead. So the economy was a bit more resilient last year. You match that with considerable economic support or financial support from Russia. Russia also just gave $500 million, or just promised $500 million this past month. So this continued support from the Russian economy is absolutely vital, of course, to sustaining Belarusian demand for the rest of this year. In terms of the ruble, the Belarusian ruble, the ruble's actually been relatively resilient when you consider, of course, the severe political pressure, the announced sanctions by the EU and the US that will be enacted likely by the end of this month. Despite all of that, the currency actually has not depreciated notably, and that's mostly because a couple of reasons. One is that it moves very closely with the Russian ruble, and the Russian ruble has outperformed this year. Secondly, the Russian economy has been performing quite well so far this year, and Belarus, about 40% of Belarus's exports go to Russia itself. So that continued export demand from Russia, but also to China and to other markets where they export a lot of their commodities. So that has also helped keep the Belarusian ruble, much more resilient than initially anticipated. So going forward, again, a lot of this will depend on the political situation in the country, but it looks like we should see an eventual transition out of the Lukashenko regime into a future government that will assuredly be very pro-Kremlin, or at least Kremlin friendly. Now, when that happens is really anyone's guess. It is very clear that the Kremlin has put a lot more pressure on Lukashenko over the last couple of months, and particularly in the last couple of weeks, particularly after, of course, the Ryanair flight being grounded over Belarusian airspace. Putin is very fearful of the spillover impact of what Lukashenko can do, and then sanctions then being imposed by the US and EU on Putin, as he would then be held accountable potentially for some of Lukashenko's actions. So the Kremlin is increasing the pressure very clearly, economically and politically, on Lukashenko to eventually transition his regime into a future pro-Kremlin, pro-Russia-friendly minimally, at a minimum, regime in the future. Our expectation is that that doesn't necessarily happen in the near future, but most likely within the next year.
Mm-hmm. All right, well, thank you very much, Mark. I think we've definitely reached the time limit for today's webinar. There are some questions that we were unable to answer, and if there are more that are on the top of the minds of our attendees today, we will be firstly making sure to follow up with responses through your client services manager, and any additional questions you might have, please send them over through via email as well. Everyone will also be receiving a recording of the presentation within 24 hours. And you can view these webinar materials and much more on our new mobile app, which is available for download right now on iOS or Android. And for complimentary access to our suite of resources, including data, dashboard tools, and market monitoring reports, do email us at info@frontierview.com. And a member of our team will be in touch. And thank you, everyone, for joining us. We look forward to speaking with you again very soon.